Now we want to understand banks as intermediaries. Okay? That is a new, I mean, I mentioned it before, but I'll mention it again now. That's a new conception. We've been thinking of banking as a payment system. Okay? We've been thinking of banking as a market-making system. Okay? But we haven't really been thinking of it as a way of funding anything. Okay? Why can banks fund things? Why can banks fund things? Why does this work? Okay, here's a bank. Here it has deposits. Okay, why can it fund things? It can fund things because people want deposits not just to make payments. The payments part requires the bank to have liquidity and worry about liquidity. We know that. Okay. But people also want deposits just as an asset to hold. They want to hold money as part of their wealth. They want to hold some fraction of their wealth in money. They don't want to spend it. They want to hold it. The households as a whole want to hold a certain amount of their wealth in cash. This is their liquidity reserve, household's liquidity reserve. So these deposits are a kind of permanent source of funding for the bank. As long as households are willing to hold them. Not only are they permanent funding, they're cheap funding. Because deposits are a close substitute for cash, and cash doesn't pay any interest. So you don't have to pay much interest on these deposits. Okay, banks compete, and now they're paying interest on deposits. They didn't used to in Gurley and Shaw's day. But even if they pay interest, it's still less interest than they're paying on bonds or something like this. So this is cheap funding. It's permanent funding, and it's cheap funding. The permanent part is why they can make long-term loans, right? They don't have to worry that all of these deposits are suddenly going to be cashed in, okay? Any individual bank might worry about that, but the banking system as a whole doesn't have to worry about that. That money demand there's a certain amount of it that is permanent. Now it could fluctuate, money demand isn't stable, okay, but it doesn't go to zero, and so they can depend on this as a permanent source of funding for making long-term loans. And they can just worry that the amount of cash, the amount of deposits demanded of them has some fluctuation to it, and we have to hold some reserves, okay, in order to absorb those fluctuations, but not the whole thing. We could have 90% here and 10% here, or depending on the instability. And of course, as a banker, you see all these data, and so you can be cautious, and you can say 50-50. And then you see that over time, basically deposits never fall below 80% of my balance sheet. So I can have 80% earning loans, and I don't have to hold all these cash reserves, and so I can reduce my reserves by a lot and expand my balance sheet and make more loans. Okay. This is banking. And it's because people are holding deposits not to make payments, but as a form of permanent allocation of their wealth to provide liquidity in case they have to make payments. But most of them won't have to make payments. So that's why it's permanent. This idea that deposits are a wonderful, cheap source of permanent funding, okay, everyone is aware of. And so society, the government wants it. Everyone wants this source of cheap funding, right? Okay, and so everyone gets some of it. Okay, if you think about the American banking system, what do we have? We have the central bank that, until recently, basically looked like this. It had treasury bills and cash. Okay, this is the government getting cheap funding, permanent funding from this sort of thing. We had commercial banks. Commercial banks. Commercial banks are making loans to businesses, industrial loans, and they're financing them with deposits. Okay, so business gets into the act. Okay, commercial banks, business gets some cheap funding, and we had savings and loans. These are the Jimmy Stewart banks, okay, that are making household mortgages. Okay, I'm going to put deposits in quotes here because legally they were sort of shares of some kind, but people used them as deposits and thought of them as money substitutes, and so they had the same dimension as being cheap permanent funding. So the way what we sort of organize is a sharing out of the spoils. Okay, society wants to hold some of its wealth in this short-term money form. Here, here, here. Okay. Different bits of society get funding from that. Households, businesses, government. But now, the finance point comes in. These banks are facing two ways, right? They're giving government, business, and households what they want in terms of borrowing, and they're giving businesses are making these deposits, they're giving another bit of society what they want, but you can't, the risk passes through. The risk passes through to someone. To who? Right? Look at the Jimmy Stewart Bank there, okay? Loans, deposits, oh, who does it pass through to? It passes through the government, actually. You see that the FDIC is guaranteeing the solvency, and the Fed is guaranteeing the liquidity. So there are these guarantees, and that's the taxpayer there that you're talking about. Okay. And because the taxpayer was involved in this, there was bank regulation that said, well, you can't make risky loans, and you can't pay interest on deposits, and they created various regulations that created an arbitrage to create non-banks that are doing the same thing. Okay. And that's where shadow banking came from. Shadow banking is created by the arbitrage, by the regulatory arbitrage opportunities provided by this sort of myth, this notion that we can give, we can take in risky assets and somehow that risk just disappears if we just have deposits on the other end. It doesn't disappear, okay? It becomes a contingent liability of the government here. In Jimmy Stewart banking, these loans are mortgages to households. These deposits are deposits of households. It stays within the community. Stays within the community. And that's how that movie works, if you remember. That he's pleading, where's your money? Your money is in your houses, And he's right. He's just talking about his balance sheet there. In shadow banking, which we're seeing up there, okay, the lending, okay, turns into these bonds, capital market securities that are traded, that have a price. This price comes from the price of risk, of all the different kinds of risks that are in those mortgages. What kind of risks are there in a mortgage? Well, there's duration risk because they're 30 years, okay? There's default risk because the households, it really depends on the income of the households. If the households don't have income, they can't pay for their mortgage. And so that's what you're trying to get rid of with that interest rate swap and that credit default swap. Get rid of the duration risk, get rid of the default risk. So that you have something that is sort of like a treasury bill. It's a sort of synthetic treasury bill. And then you fund that in the money market. So you're not getting rid of any risk, you're just hedging it. You're selling it off separately, okay? As opposed to down here where you're kind of pretending it isn't there, okay? It's the government here that's taking that risk without ever knowing it, without doing it on purpose. And so that, of course, leads to moral hazard for the bankers and so forth. Okay. RMBS has all these risks. You strip off those risks, you fund it in the money market, and then there's no FDIC backstop, and there's no Federal Reserve Bank backstop. This is just like the evolution toward mutual funds, right? Except here, these are basically money market mutual funds. Here, money market mutual funds. Just as we saw pension funds evolved into stock mutual funds, insurance companies into bond mutual funds, banks evolved into money market mutual funds, okay, which are funding a lot of this. A lot of these money market mutual funds are not even in the United States. You know, they're, because the dollar is the world reserve currency, and so the people holding deposits in those money market mutual funds might be sovereign wealth funds, okay, or foreign central banks or something like that. Not households. It's not staying in the community. This is a global system, a global dollar system funding subprime mortgages in Cleveland. Okay. This is a big evolution from where it started. Okay. And it has to do, so we're talking here about the evolution from indirect finance, Gurley and Shaw, 1960, okay, to direct finance, 2012, today, where all the risks are accounted for, all the risks are priced in markets. And there's complete integration of the money market and the capital market.